proudly very honored to have co-hosted this event with KIC. So a very, very warm welcome to all of you and our great appreciation to our team from Rwanda for making this day possible. I just want to quickly run through the program of the day, and it's going to be very brief. Apologies that we are starting a bit late, and we hope that we'll catch up quickly on the events that we have to run through. So we're going to have a few presentations from our team from Rwanda. We'll have opening remarks from CFA Society East Africa, represented by one of our board members. We'll also have a keynote address from our co-hosts from KIC, and then we'll wrap it up with a panel discussion, which I promise you will be very, very engaging. So without wasting much time, and I hope we have all interacted and gotten to know who is seated next to you, feel free to later check on our registration list to get to know who is in the room and who you would want to have side conversations with as we progress through the day. I would want to take this opportunity, without wasting much time, to welcome a representative from CFA Society East Africa, who is also our board member, Mr. George Jato Otim, to give us opening remarks, and thereafter we will kick off with the presentations that follow. Thank you very much, and I wish you a very pleasant morning and great conversation. Thank you.
Okay, good, that's fine. Good morning, everyone. I believe you've all had a chance to have breakfast, so I expect a louder response. Good morning. I would like to take this opportunity to invite all the distinguished guests to this breakfast that has been sponsored by our good friends from Rwanda, Anita and team from the Kigali International Financial Center. You can wave, Anita. Then I have my friends here from Kigali as well, who have sponsored this event. We have Parfait, Aimable. You know, I enjoy speaking some French, so from the Rwanda Social Security Board. And then we have Gael and Steven from the Green Fund in Rwanda, who have also been our sponsors of this event. And just like Ruth has mentioned, we have quite a number of presentations. I believe you're going to be, I believe are going to be quite interesting. But I think as a Ugandan, I'm a bit jealous with the progress that we are making in Rwanda. Just put things into perspective, I'd also like to recognize the first charter holders that we have ever had in Uganda, Mr. Patrick Mutimba. I don't remember where he qualified, but he will tell us. Perhaps you'll get a chance to interact with him. And then we also have Mr. Alfred Kabuchu. So those were probably, was it 2000? You were probably the first two? Yeah? When you started, yeah. Now, to put things into perspective, when I qualified, I think we were about give or take, I think 40, approaching 50. That was in 2021. And right now, we're about 56. So within a space of like 5 years, we have one per year, you can imagine, right? Now, let me share the numbers of Rwanda, and you'll see why I'm jealous, right? In 2024, there were about 8 charter holders. Right now, there are 22 charter holders. So that's 3 times the number of charter holders within the space of 2 years. And the key drivers in that market have been, for the number of charter holders, KIC and our colleagues here from the RSSB board and the Green Fund. We have their charter holders themselves, so young as they look. And he showed me his profile pic, and I couldn't believe on LinkedIn. He looked like a baby. Yeah, so imagine that's the growth. And from the perspective of the number of candidates, we have, I think, around 169 candidates across all the 3 levels for the CFA in Rwanda. And they represent about 5 to 6% of the entire number of candidates in the region. But when you look at it from the perspective of now the numbers of charter holders, meaning that they are passing at quite faster rates and having very high pass rates. So thank you so much, KIFC, RSSB, and the Green Fund for supporting us, and we look forward to you supporting our future events. We are going to have our next conference in November, our annual investment conference in Arusha. So we encourage you to all attend and sponsor as well. So thank you so much. I look forward to the presentations and the panel discussions for the rest of the morning. Thank you.
Thank you, George. We'll go straight to our first presentation from KFC. Just give me a moment to put this up. Runners, you make your way. Thank you.
Good morning. Give me some energy. As she said, my name is Rona. Thank you. I work with the Kigali International Financial Center in the business development team. And today I'll take you through a quick presentation on the KFC and why we would want the fund managers in the room, the LPs, to come to Kigali and domicile your structures in Rwanda. So I'll start off with why KFC. Or what is KFC? So we like to call ourselves an ecosystem that will transform Rwanda into an international financial center. So we don't work in a vacuum or alone. We are a government-owned private institution that was put in place to transform and develop Rwanda into a financial center. And we work with a number of institutions in the financial sector in Rwanda, which is, some of them are here with us, RSSB, Green Fund. We work with the regulators, that is the Capital Market Authority and the Central Bank. And that is what makes up KFC, what we call the ecosystem. And those are the institutions that we're working with to transform Rwanda into a financial center. So this is Rwanda's regional or positioning strategy. I'm sure most of you have heard of Visit Rwanda. You've seen it, the football fans, Arsenal. You've seen it on the jerseys. So we have tourism, which is Visit Rwanda and MICE. We have technology. So we like to call ourselves a place that investors and startups can come and try their ideas. So our regulators, both the Central Bank and the Capital Market Authority, have sandboxes where an investor or a startup can come up with an idea, take it through the sandbox, and once it's been proven to work, then you can launch. A good example I would give is Eden Care, which is an insurance firm, an insurance company that started off in our sandbox with the Central Bank. And they've now launched, and last year they were actually voted the best insurance firm in the region. So they launched in Rwanda, and then they've gone on to now move into Kenya. And the owner, I think, is Kenyan. So he came to Rwanda, proved his concept, and has taken it back home. And then under finance, which is where now KFC comes in, we are concentrating on fund and asset domiciliation, which is what I'll be talking about today. So why Rwanda and why KFC? Why do we want you to come and set up and structure in Kigali and then invest elsewhere? So what makes us unique is that we are compliant and transparent. We rank very highly on compliance and transparency across the continent. We've been ranked third in Africa on Corruption Perception Index, third in Africa on Economic Freedom Index. No. Zero corruption. We are very connected on the African continent. We have a very good mobile visa regime that allows over 100 nationalities visa on arrival. Our national carrier Rwanda also flies to over 27 capitals on the continent, direct flights. And then our population is largely bilingual, so the general population speaks both French and English, which is good for both Anglophone and Francophone Africa. And then we also rank highly on ease of doing business. So we ranked second in Africa on ease of doing business index. We have no controls on foreign ownership. So a foreigner can come in, set up a business that is owned 100% by themselves. You're allowed to own property and assets. You don't need to have a Rwandan co-owner or co-founder. We have no control on foreign exchange, so you can run your business in hard currency. And we also have no controls on profit repatriation. So once you set up your fund or holding company in Rwanda and you want to repatriate your profit back home, there is no control. And then these are the structuring options that we offer under KFC. We don't only concentrate on funds. So we have different legal structures that you can use to structure your business. So we have funds, holding companies, protected sale companies, trusts, partnerships. We also have structures under wealth management or asset management. So the private equity, venture capital, family offices, and alternative finance, all alternative investments. And we also have fintech and global trading companies. So these are the structures, and they come with different economic substance requirements and incentives. As long as you meet the economic substance requirement, then you are eligible for the incentives that come with these structures. And so for today, I will concentrate on fund structures because that is what is relevant for the conference that is going on and the audience that is here with us. So these are the different structures that are relevant for funds. We have collective investment schemes, and under collective investment scheme, you can have a credit fund, infrastructure fund, or PEVC. And these are the tax incentives that come with these different funds. So our taxes range between 0 to 3 to 15% for corporate income tax if you structure one of these structures in Rwanda. Normally, the corporate income tax is 28%. So you can see that this is really reduced rates for KFC members. And then we have 0% for withholding tax on dividends, interest, and royalties paid by the fund that is benefiting 3% or 15%. Under funds, we also have a limited partnership, which is a GPLP structure that is very tax transparent, and the tax is not on the structure but on the investors. So the LPs and GPs would then be taxed, but not the structure itself. Those can also be best used by private equity and venture capital. And lastly, we have trusts and trustees. So you can do a unit trust, private trusts, or private public trusts. And they also come with different incentives, which is 15% CIT for those that are eligible and licensed to provide trustee services. And they also have 0% withholding tax on dividends and interest. And these trustees or trusts can also benefit 3% for CIT. So now I'll take you through how do you establish a fund. Once you're convinced that this is where you want to domicile your fund, how do you do it? So it's a very easy and quick process. So once you come into Rwanda and you want to set up a structure, the first thing you do is that you incorporate or register an entity with RDB. After registration, if the structure that you've put in place requires a license, then you would go on to register for a license from capital markets, which is what regulates the fund or asset management sector. And once you've been licensed, you go back to RDB to get what we call an investment certificate, which is then what gives you the right to benefit these incentives. So the process takes about 2 to 3 days for registration. Sometimes it can even take 6 hours because it's online. So if you have all your documentation ready, 2 to 3 days or even 6 hours to register. We have a staff that sits at the one-stop shop at RDB that is there to help you. And once you have registered, the Capital Market Authority takes 30 days from the point that you submit what they consider to be a complete application. So once you submit your complete application, they should get back to you after 2 weeks as the first stage, and maybe then within 30 days you receive your license. And then the investment certificate takes about 5 days, and you're done. You have the right to operate, you have the right to benefit these incentives. And we have something called the TCSP, or Trust and Corporate Service Provider, which is a licensed entity that has their role is to advise investors who come into the country to make sure that this process that I just took you through is smooth for the investor. So they are licensed, they are more conversant with how these processes are done. They work better with RDB. So we like to encourage investors to go through the TCSPs to make the process easier for them. And next is some of the successes that we've had. So KFC has been in place for the past 6 years. We started in 2020. And so far, this is what we've been able to achieve. So I would say the first 5 years were just to lay a foundation, to put in place laws, build partnerships, and, get ready to build a financial center. So these are some of our success stories. We've gazetted over 22 laws in the financial sector. We have made partnerships with other financial centers like Jersey and Luxembourg and Qatar and Singapore. We are ranked 3rd in Africa against Casablanca and Mauritius on the Global Financial Centers Index 2025, but in actual sense we are competing with Mauritius. Casablanca is way out of our target market. And then we have over 570 million assets under management. So for the new investors, the 300 financial actors that have registered under KFC, their assets under management come to 570 million USD. And we also have KFC Financial Skills Council, which is responsible for what George was talking about. So we encourage the people in the financial sector to take up courses like CFA and ACCA to make sure that we have the right skills to serve investors once they come into the country and they're looking for staff to hire. We want to make sure that we have the right skills. So this is our success story so far. And then this is the success story in terms of asset management. So far we've attracted the Fund for Export and Development in Africa, which is a fund under the Afrexim Bank. It's managing 670 million, and they've domiciled in Rwanda. They've been there for the past, 3 years. And so far they've put in place around 4 different funds under FEDA. We also, our first fund that domiciled was the Virunga Africa, which holds 250 million. And this was a collaboration between our pension fund, RSSB, and the Qatar Investment Authority. And it's being managed by Admires, which is a fund manager that also came in at the same time as Virunga, just to manage it. We've also been able to attract other service providers like Apex and Ditos. These are fund administrators that are also in other jurisdictions like Mauritius and Hong Kong. We also attracted Martha Capital, Enco Capital, and CPF Capital and Advisory, which is from Kenya. That was 2025. And we also attracted ABAN, the Africa Business Angel Network. So this is our success story so far. We have much more in terms of other structures, but this is specifically to fund management or asset management. And now I'll speak about our key priorities. So for the next 5 years, now that we've put in place a foundation and we have gained some momentum, our priorities are now under still asset management. So we want to attract more fund managers or fund administrators to come and set up in Rwanda, manage their funds there. But the difference is that we don't ask you to come and invest in Rwanda. We invite you to come and structure your businesses in Rwanda, and you have the right to invest anywhere on the globe. So it's not necessarily just invest in Rwanda. And of course, we are happy when you invest in Rwanda, but you have the leeway to invest anywhere else. And then we have climate finance, so we are working to be the first financial center that does climate finance, and we are looking to do carbon market aggregation for carbon credit trading. And I think our green fund is doing something around that. And then we also still have fintech. So fintech is where we've actually attracted a lot of fintechs over the past 5 years. We've signed agreements with Kenya and Ghana for a passporting license. So once you have a license in Kenya or Ghana, you can come to Rwanda and the licensing process will be shorter and easier compared to someone that is not from those jurisdictions. We are also working to sign with other countries. You're next. Uganda is next. So we are working to sign with other countries within the region and beyond. And we've also seen some of our fintechs go to these markets and get the equivalent of the license they have in Rwanda. So we've had some good traction on fintech, and it's also still our priority for the next 5 years. So a fintech will also support then the asset management and the climate finance in terms of technology. So these are our key priorities for the next 5 years. We invite you to come and set up your funds in Kigali. One of the things that we do as KFC is that we support the investor journey from start to finish. So once you approach us and you're ready to domicile, we'll hold your hand and take you through licensing, connect you to the right TCSP to advise you. And thank you for your time. We look forward to having you come to Kigali.
Thank you so much, Rona. If you have any question for Rona, just raise your hand and we'll see if we can get a microphone to you. If you can be audible enough, we can take maybe 3 questions.
Morning. Morning to you all. My name is Alan Mark Lutaya, and I'm a legal practitioner majoring in banking and finance and payment law. And I work with SM & Co. advocates, formerly Shanubi and Musoke. Thank you for the discussion, for the presentation, Rona. My itching point, and maybe it could be a question that you could share your view on, is in respect of FEDA, which I would understand to be a subsidiary of AfriExim. And being a payments enthusiast, and by default a fintech legal practitioner, I'm interested in picking your mind on the Pan-African Payment Settlement System, which is a cross-border payment solution, and how it would catalyze the investment and financial inclusion in Kigali and East Africa at large. Of course, we also have the East African payment system, but I see with AfriExim in there, and the fact that maybe the Central Bank of Rwanda has not yet been onboarded as a partner to the whole payment ecosystem, isn't that something that might deter investment in the long run? Maybe I just need to pick your mind on that. Thank you.
Thank you. That's quite a difficult question. So it would be helpful if our central bank would be connected to the PAPs. And we do have a country host agreement with the Afrexim Bank. So we have other things in the pipeline to work on with them, not just FEDA. FEDA is just a fund for export that has domiciled in Kigali. But we have other works with the Afrexim Bank since they do have a country host agreement, and I believe our central bank is working towards joining the PAPs. And indeed it would be helpful if we could make payments better across East Africa and Africa at large. And it's something that we are working towards as a country. Yeah. Thank you.
Good morning. If I can remain seated so that I don't stand on top of people. Thank you for a very good presentation and sharing, I think, the vision of KIFC. I'll start with two quick questions. One, since we are in Kampala, I'm interested in understanding how you are working with the institutions in Uganda and what it is that you are doing with them. We appreciate that you are working with the CFA Society East Africa. That is very good. And thank you for sponsoring this breakfast, which is very good. But we would like to understand how you are working with other institutions so that as Ugandans, we're able to know where to add in and create value. My name is Alfred Kabuchu. I'm a partner with Biz & Co., but I'm also a vice president at ICPAU. Then my second question, as you presented, I was thinking, and you also mentioned about Mauritius. I was wondering, as KIFC, is your vision to be another offshore destination that is onshore so that you can compete with Mauritius and other offshore financial centers? Is that the vision that you would like to go to, or is it what you are? And if it is, where are the gaps and what are your comparative advantages that would make a person in Uganda who is interested in opening up an offshore entity come to Rwanda instead of going to Mauritius? Thank you.
Thank you. So the first question, how are we working with institutions in Uganda? We do have an event called the Inclusive FinTech Forum, where we gather central banks, regulators, investors every year. So the Ugandan Central Bank is part of the banks that we work with that is actively involved, and they've participated over the years. We are also working with I&P, the Ugandan office here, to support us on fund management, to develop our fund management ecosystem. And I also believe our Capital Market Authority does have a relationship with the Capital Market Authority here, and we do intend to pursue an equivalent licensing, passporting thing with both the central bank and the capital markets. So for now, that's how we are working with Ugandan entities. And for the second question, yes, we do want to become like Mauritius, and we've benchmarked on them. They were our benchmark as we started. We don't call ourselves an offshore, we are onshore, so we are serving the continent. We are on the continent, and we want to serve Africans. They don't have to go to Mauritius to domicile their funds there, yet there is another jurisdiction that is closer. Our comparative advantage is indeed that we are on the continent, so it's easier for a Ugandan to fly into Kigali and fly back in the evening than they would have to go to Mauritius. And we also have the gaps is that in comparison to Mauritius is that they have more track record. They've been in the business longer. They have more double tax avoidance agreements. I think they have around 40. We have 18, but we are working towards achieving more. We have a number of them in the pipeline that have been signed but are awaiting ratification. So say in the next 5 years we could catch up with them and have 40 and close the gap and also have a good track record like they do. And more of a advantage over and above being on the continent, we have the same incentives. The tax incentives are exactly like Mauritius. So 3 to 15% is what they offer. And our financial center is not zoned in an area. So you don't have to come and maybe be like in a place in Kigali. It's across the country. Thank you.
Discussion after the breakfast.
Yeah, after the breakfast, I look forward to networking with a number of you.
All right, let's give her an appreciation. Thank you very much. As we get ready to welcome our presentation from RSSB. Shahira, you're very welcome.
All right, good morning, everyone. Hope you've had a good breakfast. As for me, not yet because I'm nervous and I cannot eat before it if I'm still nervous. But anyway, good morning. Thank you everyone for being here. So my name is Shahira Zakirin. I am the head of Asset Management Department in Rwanda Social Security Board, the pension fund of Rwanda. My first time here in Uganda, actually. So yeah, thank you so much. Thank you so much. Yes. So for today's breakfast event, the title that's given to myself for the presentation is as above, the Institutional Investor Perspective, Allocating Capital to African Alternative Investments. So to start, let's just dive into this title because it's quite a mouthful, isn't it? There's just several big ideas in one sentence. 4 key ideas that I can dissect here. Number 1, institutional investor. Okay, so who are institutional investors? It's basically investors. We have capitals with liabilities and governance structures, and most importantly, a mandate. Okay, so it's not just money, just looking for returns. A bit more on that later. The next concept is capital allocation. It's about being intentional where we allocate the capital into. So it's not just about picking one single product, one single fund, one single investment in our portfolio, but it's about a higher level, a more strategic asset allocation, if you will, to solve the portfolio problems. The next term I want to dive into is Africa. The African continent. Here we are in Africa. So basically, why Africa? It's because it's where the growth is at, and that's where the financing needs. It sits outside of the public markets. So how do we connect between the real economy, where people actually need the funding, versus the stock exchanges? There's a disconnect there, financial versus real economy. And the last thing, which is the main the main discussion of the conference itself tomorrow, will be alternative investments, which I think is a funny asset class on its own. Why? Because it is defined by what it is not. It is not traditional, hence it is alternative. It's just, there's no particular one definition of alternative investments. So let's dive into all these 4 concepts in a bit more detail. So firstly, on institutional investors, you have to know that not all institutional investors think alike. So especially for fund managers, for the GPs, especially if you're fundraising, you have to know that not all LPs have the same priorities. Not all LPs have the same regulatory limits. Not all of us have the same strategic mandate, etc. So, pension fund. Pension fund, that's where we collect the money from the members via contributions. We grow the money. and then the money that has been grown, we pay out to the members. So at the end of the day, we have to pay out the members. So that is the main mandate of a pension fund. But we are not the same as insurers. Even within the insurers group itself, there's short-term insurances, like for fire insurances, for casualty insurances versus a life insurer. They have really different liability profiles. So even for short-term insurers, they might not even invest outside of money markets because their liabilities are a lot less predictable. Life, they can do a lot more. Okay, but it also depends on their commercial, if they have any CSRs, etc. So you have to know your LPs. DFIs that goes, their mandate is to develop. It depends from each institution, but basically they can be a little bit more flexible on the returns, but that does not mean that this is just free money. This is not necessarily grant, but it is more on impact investing. Endowment and family offices also a bit more flexible depending on the priority of the high net worth individual that they're managing the money for, depending on if maybe the billionaire's son, he loves whales, so they will invest more in WWF, for example. Sovereign wealth funds, so this is definitely more from a strategic investment perspective. National priority is definitely the number one mandate for them, and they have very low liquidity needs. So those are the things that you need to keep in mind when you approach LPs for fundraising, for capital. Okay, so particularly for RSSB, we are a pension fund, so we invest for decades, not just for quarter one or quarter two management reporting. So we need to balance that. And one point that I also must point out is that RSSB, not only we are the pension fund of Rwanda, we are also the largest institutional investor in Rwanda. So a lot of the national development priorities from a financial perspective, we do play a significant role in that. So strategic priorities is not something that RSSB can and should escape away from. So that's another thing to keep in mind. These are unique to each LPs, I would say. So capital allocation. From institutional mandates, we translate it into portfolio strategy. So capital allocation is actually the tool that an investor would have in their pocket to actually solve real-world problems with the capital that they have. Okay, so we start from institutional mandates, and then we have the institution has a mandate. Okay, and then we also need to consider what are the constraints. For example, RSSB, even we are to a point regulated by the National Bank as well. There are certain regulatory limits that we need to look into. In terms of foreign investments, it is something that we can do, but within limit. So those are also the considerations that ask your LPs, ask your institutional investors, what can and what cannot work for you. And then, putting aside the constraints where you cannot go, then you look into where can you go and where should you go. So those are the portfolio objectives. And then the bridge between that portfolio objective to the real world outcomes, depending on the mandate, is where we should invest. And this is just a snapshot on the different different type of alternative investments, which translate into real world problems that we want to solve versus what's on the right side here, what's the portfolio objective, okay? So it's more of a heat map. I won't go into detail, but just to show that different type of investments will help to solve different problem, or on the flip side, it can also give you a different set of exposures. So it really depends. There's no one size fit all in terms of what you should invest in as an institutional investor, okay? So, but it's also important to point out here, we invest not just to allocate to asset classes, just because alternative investment, it sounds cool, it sounds edgy, kind of, why not just put 5%? No, it shouldn't be the objective, but a more sophisticated institutional investor will be, what exactly that I'm trying to solve what can be solved by putting in money in a private fund, private equity, infrastructure fund, etc. So yes, I mentioned this earlier, alternative investments, but it's alternative to what exactly, right? So what is not alternative is basically the traditional asset classes. So what are those? Cash, government bonds, corporate bonds, listed equities, basically the listed instruments that you typically see in a deep financial market. The historical context of this shouldn't be ignored. It's called traditional because it was the dominant model, or maybe to an extent still is, the dominant model in North American and European markets throughout the 20th century. But we are in Africa, and our markets are structured a little bit differently. The reality of the situation is, right? So a bit more on the traditional asset classes. So they are genuinely liquid. So there's this assumption that it is mainly priced efficiently. The market is efficient. So when you invest in a traditional asset class, you will have very limited ownership. If any, you will go to the shareholders AGM and then vote, but that's it. And it's really dependent on market access. But as for the alternative asset classes, it's just a mix of so many asset classes that are not cash, that are not listed bonds, that are not stocks. Everything that falls outside the traditional framework. So it is a lot less liquid. It is very subject to deal by deals negotiation. Hence why the conversation about where do we domicile the fund comes about. So it's part of the bigger picture on the legal protection, on the regulatory framework that basically gives the investor the protection to invest in these alternative investments. And but usually when you invest in an alternative asset classes, you will have more governance over it. You will have more ownership. You can be more intentional on what type of the market that you want to have access to. For example, you don't see, I'll take it Rwanda for example. For the Rwanda Securities Exchange, it is heavily concentrated on financial sector and maybe some breweries, but you don't see infrastructure kind of exposures in the listed equity market. You don't really see housing, for example. So what are the options for RSSB, the pension fund, to have exposures to those sectors? So the answer to it, part of the answer, is alternative investing, okay? So that's what it meant, that the direct exposure to the real economy. So to reiterate, alternative is not an economic category, but a historical one is defined by what it is not. So the last part I want to talk about is the call to Africa. Why Africa and why now? Okay, so basically 3 main big reasons why. Number one is Africa's financing needs have become too big to ignore. The urbanization rate and the population growth has been, been very high for Africa. It is a very young continent, and there are still large infrastructure and financing gaps. Of course, there's a lot of industrialization going on. There's a lot of SMEs that make up over 90% of the economy here in Africa. So these are the financing needs that basically the gap has just grown a lot more in terms of the funding needs versus where does the capital actually flow to. So that's number one. Number two, the African institutional capital has reached a critical mass. So maybe back then in the 60s or the 70s, African institutions, maybe the pension funds themselves, they are still in a nascent stage. You don't have that much of capital to talk about large-scale mobilization to begin with. But starting in the new 21st century, that trend has changed. Maybe, for example, South Africa, they have a very large pension fund. Maybe even Botswana. Even take RSSB, for example. Our asset under management today is about 2.5 billion US dollars. So that's roughly about 1/6 of our country's GDP. And we are the largest institutional investor in Rwanda. We also recently had a pensions reform that took place 2025, so it's been a year and a half, whereby the contributions rate for the pension scheme, it was 6%, but it has increased to 12% right now, and the increase is still it's still ongoing. So there's more like mid-term targets to increase that further up to 13 or 14%. So that just goes to say there's more and more capital being collected from the general population, from the economy, into an institutionalized investor fund assets under management. Okay, so Africa finally has significant domestic pools of long-term capital. So that's the second reason why. And the last part I would touch on is the policy and institutional push towards domestic capital mobilization. So AFDB was African Development Bank. It was established in the 60s, in 1964, but it took a few decades. Only in the 2010s, that's when things really start to ramp up. So in 2013, African Union launches Agenda 2063. So that's more, it's more explicit in terms of the push for domestic capital mobilization. Something more about the economy, to strengthen the economy, Africa for Africa. So all that has actually been institutionalized in policies. Hence the conversations that we're having here today, right? So in about 2015, Africa 50 group becomes operational. So this is also, Africa 50 has its legacy coming from AFDB as well. Fun fact, RSSB also invests in Africa 50's Infrastructure Acceleration Fund. We just closed them in June. That was last month. It felt like a long time ago. But yes, yes, we just closed that investment in Africa 50. So we're excited for these investments because this is really in alignment with our mandate, Africa for Africa, putting more money into the institutions to just, infrastructure is a very important investments for. It has the multiplier effect. I'm sure you all know that. And so there's also talks about AFCA, and then in 2020 onwards, the rise of KIFC, and then private capital ecosystem. So the short of the long is that mobilizing domestic capital, African capital for Africa, has been more intentional in the past decade or so. So the question right now is no longer if Africa needs capital. Africa does need capital. But the question is more on how Africa's own saving can finance Africa's growth. So this goes to my closing remarks. So perhaps alternative investments are not truly alternative in Africa. You can argue that our alternative investments is a nice to have in a developed market. It's just something more avant-garde, something more unique. It's a complementary role, but in emerging markets, in frontier markets like Africa, alternative investments is the market. It completes the market. So maybe this will be the most natural way to finance the continent's growth, but it's not as simple as just putting in money and just pray, hope and pray. That does not work, especially when we have pensions to pay, okay? So the three things that need to happen is that the capital needs to be patient. You can't expect to get returns in 3 years, 1 to 3 years. That does not work. Infrastructure investments are decades long, for example. Number one, patient capital. Number two, disciplined institutions. Even as RSSB, we have done great things, I would say, but we are still growing. There's still so much more to grow as an institution. So that's the trajectory that we're headed on. So we need to have strong governance. We need fiduciary responsibility remains non-negotiable. We need to build the teams. Even the internal process, how we look into the investments, need to be more intentional, need to be more structured. All that work has to be done by the institutions themselves. If if you don't do it, then as the catalyst of the market, you are in the unique position to be doing so. Okay, and the last thing is not just the institutions, but also the enabling ecosystems. We need to have the right market structure, the regulations, the institutions to support. For example, again, KIFC, they've been helping with getting the funds to be set up here in Rwanda, and for the legal framework to follow. That's this whole discussion about Rwandan law versus Mauritian law. I'm not going to talk about that here, but yes. So these ecosystems will determine whether the capital actually reaches the real economy or not. So I guess in conclusion, I would say that the future of African alternatives and the growth of Africa will not only depend on the capital itself, but also the institutions and the ecosystem that steward it. Thank you. Is there any questions, or should we move on?
Thank you very much, Shahira. I hope I've gotten your name correctly.
You got that right. Thank you.
So my name is Bernard Kiarie. I'm a CFA charter holder. I work at Algam Africa Capital, which is a consulting and business advisory firm. And we've done work across about 18 markets in Africa now, just building capacity and supporting SMEs and the entire capital market and private market ecosystem. So mine is just, so there's something you said that caught my attention, which is that our RSSB invest in decades, right? And when you look at just our experience in Kenya, so the same is true for our National Social Security Fund. So it's true on paper, right? And because of the nature of the funds, they have a very long investment horizon. But when it comes to market practice, as a result of the quarterly reporting of the fund managers to the trustees, there's an element of these quarterly reporting returns are very critical. So if a fund manager comes and reports a negative return, then in the next allocation cycle, they don't get allocated funds by the NSSF or the National Social Security Fund. So in practice, then, that creates incentives to be very short-term in nature. So the underlying nature of the fund, which is long-term investment horizon, does not play out in practice. Because of that short-termism. And so when it comes to asset allocation, then you tend to see significant allocation in government securities because they need to report positive returns every quarter. So even within the regulatory allocation limits, there's no significant investment into alternatives, right? So I don't know what has been the case for RSSB, but that has been the case for our market in Kenya.
Thank you, Bernard, right? Yeah. Thank you for the comments. Maybe I can just add some comments on that. I would say your observations are spot on. Maybe the reasons why and what could be the next call of actions will be, number one, it's for the institutions themselves to, it's kind of like an education, a learning journey between the LPs on our side, the investors, versus the fund managers. So you mentioned there might be a certain period where the returns might be negative, and then when that happens, the GP will not get more capital. So that is unfortunate, but it is a real case when an institutional investor, you don't really see that this dip in the J curve is actually expected. And it could be a negative performance, but then it could be a lot more negative. So technically, the fund manager is actually relatively overperforming, but it's not viewed as such. So I think this is the part that falls under the institutional investors themselves needing to grow to understand more what is expected from this kind of investments. So you could, maybe the fund manager could explain a bit more this negative, this curve is expected because we need to invest more capex on the growth capital for this particular firm, and then once the cyclical revenue cycle, it looks like this, so we can expect that. So you can be more intentional in terms of attributing the performance measurement, I would say. Another thing is that not just the institutional investor, but also the ecosystem. For example, if the national bank or the regulator comes to a pension fund asking, why are you not performing this quarter, as if holding us accountable for a slight dip in the returns, that's not helpful as well. So it's not just the investors themselves, but it's also an ecosystem trying to catch up to how these investments work, because you cannot invest in a long-term mandate, but you are being incentivized for short-term returns. So I think it's a bigger call for a change. Thank you for your comments. Yeah.
Thank you very much, Ahira. I think that was a really brilliant presentation. My name is Remy Wahanze. I've been fortunate to work for a fund manager, but also now to be an advisor on the legal side. I work for Taslaf Advocates. And I have specifically 2 questions, and perhaps maybe to just add something to what my colleague said earlier regarding the issue of quarterly reporting. I think what we're seeing, even in the West, which we're otherwise terming as mature markets, there's a push towards removing the quarterly requirement. And so I find that it's more relevant for us, actually, because the pressure on asset managers is to ensure that the assets are deployed so that, there's an existent growth. But as you've mentioned, the J-curve is very clear, especially for growth stage businesses. It's very hard for you to be able to make a return when when it's investment period. So I mean, all growth, or you're trying to turn it around. And the question that I had is regarding the example that I was just speaking to my friend Parfait here. And he was telling me about, and I heard it in the news as well, the SME fund you did with Enco Capital. And maybe just to get a few lessons from you on the structuring. One, did you structure it as a permanent capital vehicle? Because we have a lot of issues around liquidity, right? Mm-hmm. And so what would you recommend to be the model, especially for us who do the structuring and, reaching out to the regulators in terms of how we structure the permanent capital vehicles to provide mid-term liquidity for asset managers? For the investors. Mm-hmm. And so I'm curious to understand how that was done, or how you guaranteed that, or you went the traditional route of a 10-year horizon fund, because you've just said that in a space of, the initial fund life cycle, first 2 years you're trying to set up, you're in year 3, you sort of like start deploying, no one has heard of you, the concept is new within the African market, it becomes difficult for you to break into SMEs because they have cheaper debt, and so it becomes like very hard for you to deploy the fund. And then in year 5 they're asking you to begin harvesting, and then effectively you're in a catch-22, so now you're seeking a continuation and the like. So I would like you to probably give us a picture of what is happening with PCVs. Of course, it's good that RSSB is on board, because then they have more long-term institutional capital. But I'm curious to hear your thoughts on that. Thank you. Sure.
Thanks for your question. So I didn't mention it here, but just for everyone's knowledge, like my friend here mentioned, Rwanda RSSB, we recently, together with Enco Capital, we launched the Rwanda SME Growth Fund. So it's basically a fund that was co-created by RSSB and a selected fund manager. So this fund manager, they went through the whole RFP process, the whole selection process. So yes, so it's a private credit strategy fund. And the reason why, yes, to answer your question, yes, it is a permanent capital vehicle. Why did we not just keep it to 10 or maybe 15? Reason why is that we want the number one, we want the fund manager to have a flexibility in terms of the duration of the credits that they can extend out to the SMEs. We don't want to put them in a position where maybe at year 5 of the fund, and there's one good deal that they can probably structure, but to make it work from the SME side, they need 7 years instead of just 5 years. We don't want them to say no to a good deal just because of that. That's number one. And number two, RSSB, we're here to stay. We're not going anywhere. We're here in Rwanda. So why are we limiting this to just 10 years, right? So those are the motivations that go into a permanent capital vehicle structure. So how it works is that this fund, it is anchored by RSSB. It's a local currency fund. So we have anchored the first close, which is an equivalent of $30 million, but we're targeting a final close of $100 million. So the next question will be, is it just RSSB funding the fund, or we're open to have more institutional investors to come in? The answer is the latter. Yes, we are open for the institutional investors to come in. But how does NSSF Uganda invest in Rwanda permanently? But what if our strategy changes? We've thought of that as well. So for that, part of the structure of that permanent capital vehicle is that if an LP, not RSSB, an outside LP, if you want, you have the freedom to get back your investments, but of course with a 12-month notice period. So that was part of the structuring of the permanent capital vehicle. But aside from that, in principle, RSSB, we're happy to put in more money into the fund, provided that we achieve the objectives. So it's not just about chasing the returns for the fund manager, but what's the type of SMEs that you have helped. So we are now in the midst of closing the first deal. So just stay tuned. Maybe we'll post on more stuff on LinkedIn. Yeah. So to follow our journey. Thank you. Yeah. Anything else before I hand over to... Okay. Yeah.
Thank you very much for your presentation. My name is Daniel Mutu. I'm a CFA charter holder. So I actually concur with that last statement. Alternative investments are truly African in nature, because we notice that in Africa we have large infrastructure deficits as compared to the Western world. And in Uganda and East Africa at large, we see that many of the institutional investors are investing more in traditional asset classes, predominantly fixed income and equity, probably due to the risk that they perceive in alternatives, or maybe the lack of expertise. Now the question comes, what would be the best way for institutional investors to invest in these projects? Should we see them doing direct investments in like hiring people and going and investing? Let's say there's a road toll project, an oil refinery, or let's say in an SME, or should we go the route of domiciling a private equity fund, let's say an infrastructure fund, for example, and pulling capital along from different institutional funds as institutional investors as LPs, and then having those experts deploy that capital and then return it back to the investors? From your expertise, what do you think would be the best approach for us to be able to tap into that money?
Okay, thanks Daniel for your question. I think it can be more of a hybrid approach, maybe depending on the specific institutions that you represent. So, but maybe one element that was not mentioned just now, I would say partnerships. For example, the large DFIs like World Bank or IFC, part of their mandate is to even grow more, to help develop African institutional investors as part of their larger mandate of mobilizing domestic capital in Africa. So there has been several deals that we look at where hiring, well, that may be necessary as part of growing your own teams as well, but you don't need to hire for every single specialization. I mean, especially as a pension fund that's in developing Africa, we do not have that luxury. So one route that you could consider is with the small small core team that you have, you can explore partnerships with these more matured DFIs. They have dedicated teams to look into infrastructure. They have dedicated teams to look into specific markets. They have dedicated teams to look into deal origination, due diligence, deal execution. Everything is so specific by the life cycle, by the markets, you name it. But of course, most LPs in Africa, we don't have that luxury. So I would, maybe just give a suggestion. You can explore partnerships with them. So just talk to them and say that, hey, I heard that you are looking into ABC fund, that you are doing due diligence as well. Can we tag along and just have a look at your process of the due diligence? Depending on their internal policy, there are certain detailed notes that they may not share, but at the very least, there's always something that you can learn from them, be it at a high-level, framework level, or maybe just side coffee chats, talking about, oh, that fund manager, I heard in his last fund, they did something. So explore that, I would say. Yeah, utilize that. Thank you.
More to eat so that we can try and catch up on the lost time. Is that okay? All right, moving on very swiftly, we'll now welcome Rwanda Green Fund to take us through their presentation. Thank you very much, Ahira, for sharing that institutional perspective. So I would like to welcome Rwanda Green Fund. Let's welcome him very nicely as he takes his spot.
Thank you so much. I think I'll just get started. So
Yes.
I'm one of those who hates awkward silences. So I always have random fun facts. Like a group of pandas are called an embarrassment. So, crazy stuff. Not to... Yes. So not to be cliche and all, my name is Steven and I'm from the Green Fund. So I'll start with a very common African proverb that probably all have heard about, which is we're all sitting under a shade of a tree that someone else planted a long time ago. I didn't come up with this. I paraphrased it, so don't quote me on that. And I'll explain the reason why I started with that proverb. So imagine 7 years ago, you are starting an e-mobility company in Rwanda. And banks are not willing to lend. It's a greenfield project. It has no proof of concept. Equity investors, they're not really sure whether the business is investable. But now move forward to now. This business has grown. Equity investors are knocking. And we're seeing the industry raise over $20 million. So here we're seeing the market has grown, it has evolved, but the question that remains is, has the capital evolved? Well, the market evolving didn't happen in a vacuum. We've heard from KIFC and RSSB the great work they've been doing in Rwanda, but I'm sure in the region, all your institutions have been contributing. This did not happen in a vacuum, so I'll be selfish and start off by talking about the Green Fund. So what is the Green Fund? So it's a flagship climate finance institution. It was established in 2012, and the whole idea is, why don't we tap into this already existing capital in form of grants and catalyze the market? So ever since our establishment, we've raised over $360 million and have invested in 118 businesses and projects. They're both public and private. So over the years, we've learned from the ecosystem. So we've built that ecosystem knowledge, built trust and relationships with various institutional entities, but also other stakeholders in the ecosystem. And we've helped grow a platform. So we didn't enter this system. We helped build it all the way in support with other stakeholders. But over these years, we've started realizing something. The gap has shifted. Initially, we needed the funding to support startups, and now we're seeing these businesses grow. And when I talk about these businesses, I'm not just talking about Rwanda, I'm talking about the region. So there is this chasm that has come up between early stage financing and already established businesses where the businesses that have received the grants and they have outgrown it, they can't get any more grants because they're already big and they're able to sustain themselves to a certain extent. But again, they're unable to raise funds over 5 million. So what does that mean for the Green Fund, the market in Rwanda, but also in the region? Our strategy has been mostly grant-based. So we've been grant-making, so doing both regular grants and recoverable grants. And now we're realizing the market can't heavily rely on grants. What if we explored something different that some of the speakers have already talked about, and that's equity. So how does a green fund go into equity if they have developed expertise mostly in supporting businesses, building that track record through grants? So I'm introducing what I hope we can take away from this session. It's an investment arm. So this will be a platform. It will be very privately governed, and it will host multiple investment mandates over time. And why are we setting this up? Well, the landscape is changing. We're trying to evolve the capital, as mentioned earlier. So we're seeing 18% of climate needs have been met, but also with ongoing craziness in the world right now, this is dwindling even further. But again, remember the tree we talked about? How do we keep it alive so that some future generations can sit under it? But then the next question becomes, why now? Well, we've seen the pipeline grow. There's some cool businesses that I'll touch on that are coming up. Well, we're not investing in them because they're cool, but because of the work that they're doing. So they're already maturing and they need this capital to not grow, just grow, but to scale. So just a key takeaway from this is for the investment arm, so it will be institutional grade, under institutional grade governance with an independent investment process, fiduciary oversight, and a clear separation from grant-making activities. So the grant side is totally different from the investment arm. So it's very, very critical that it has this level of independence. So this is how it will look like. It will be a platform, and we'll have various funds. So someone asked about how should we just set up an energy fund and just come to Rwanda? So if you're in the green space, if you're very enthusiastic about it, through this investment arm, we'll be hosting various funds. So the two I'm showing here, it's what's in the pipeline. So there is Fund 1, which I'll touch more on. So it's more venture, growth equity across various sectors. But also there's a Fund 2, which will be energy focused. So how do we improve access to energy across the whole country in remote areas, and there are also various use cases. And here we are already engaging institutional investors and some investment managers who will support us to provide that additional expertise, so that we can work together to run these funds or provide a space for such catalytic investments to be made within the space. So for Fund 1, we are envisioning between 20 to 50 million fund to run between 10 to 12 years. And again, this is something that will be decided based on further LP engagements. But from what we're hearing from various stakeholders, this is what we're thinking. And the target investments will be, again, someone asked me, do you only invest in Rwanda? And the answer was yes, but for now. So now the investment arm will open it up. So how do we, yes, invest in Rwanda? We are a Rwanda-based entity, but also, can we also invest in businesses from our sister countries? And that's what we'll try to do here. The ticket size we're thinking is between 1 to 6 million per business, and then with a minority stakes of 5 to 7 year holding period. The funding sources, so within the green space, it's very, very critical that we do blended finance, and I'm sure throughout the conference, that's all you'll be hearing about. So how do we tap into the concessional funds, commercial, but also mezzanine? To kind of de-risk, but also be creative and achieve the impact that we're envisioning. But then why RGF's investment arm? and I think I did touch on that a little bit. So we are in Africa's fastest growing, among the fastest growing stable and innovation markets. And when I say this, I mean not just Rwanda. The region is really, really growing fast. They're growing as fast as my nephews and nieces. But also we are seeing a lot of investment-ready opportunities. So we did analyze over 240 opportunities just in Rwanda, and we earmarked 10 investments that we thought were good for this. And they're aiming to raise over $280 million. So this is subject to a fund manager's assessment, but if this is what we're getting already before we even set up, you can imagine how many more business we can uncover in the region, even beyond Rwanda. And we have extensive experience in the space as the Green Fund, but also we're willing to partner and work with experienced institutional investors who can work with us and make this a reality. So building on their fund management expertise. So then the next question becomes pipeline. So I did mention some of the 10 companies. I won't go deeper into it. I'll just give 2 examples. So how many of you have been in Rwanda recently? By raise of hands. Don't be shy. 10 years. Yes. So there's been a drastic change. So if you're moving around the city of Kigali, you will see electric buses. And that is something I never personally used to imagine, finding electric buses given how huge they are, let alone small buses. And most motorcycles, the borders, they are now electric. So we are seeing that shift. And I think with the world right now, with the fuel prices now that have become gold, we're seeing this becoming a reality and a necessity more so. I'll also probably touch on one other company that I thought was very cool, which is it's a drone company. So what they do is, if you have a farm, you have 1 hectare, you have to water it. Most times it will take like a week to do that, depending on the pace. They can do that in an hour and at a fraction cost. So there are all these innovations that are also contributing to a lot of green stuff, so making sure there's that food security. So how do you invest in such businesses? And I think that's what the investment arm is envisioning. So one case study, which I did touch on, was Basigo. So those are the buses I was talking about. So for those who didn't raise their hands, when you come to Kigali, come ready to ride one of these buses. They're really huge, and you'll be with so many people in it. So you can make friends. So what's the ask? So I did mention that we've really worked to build this economy, working with various partners. So I would like to invite you to join us. Join us, learn more about the investment arm, support with the investments where possible. We are happy to discuss and figure out how best we can do this. So you can help us best structure it, and I think there is a lot that we can do together and build that tree that our future generations can sit under in the next 10 to 20 years. Thank you so much, and looking forward to engaging. I'll open it up for questions.
My first one is, what's your name?
Yes, so my name is Stephen Mucho. When I came to Uganda back then, they used to make fun of my last name. So they would say Mutromo because of, for those who know brochette or kebabs, I don't know if that's a thing. But yeah, so my name is Stephen Mucho. Thank you so much. I'm the investment manager at the Rwanda Green Fund. It's a pleasure.
At least I knew you, but I wanted the rest to make sure they know.
Thank you so much.
My name is Kevin Karobia, an investment manager at BK Capital. The previous questions have been asked by charter holders, so I'm trying to make progress towards that. But specifically to this, and I also had a question for Shaira as well. And it's interesting because on one side, I think running a private credit fund at BK Capital ourselves, 2 of the main challenges are 1, raising capital, and 2, pipeline. On one side, Shaira has capital. On the other side, you have pipeline. We already have 10 investable opportunities. So when like also you are targeting investors for this. Is Shahira also one of your targets as RSSB? I would want her to say yes, so that I can also bring a proposition to her. And then in terms of your structuring of the investment arm, I think from Rwanda and from an ESC perspective, or maybe given that we're in the private credit space, has it been easier to fundraise equity or to fundraise debt capital? And what, I know you've mentioned that you are leaning towards equity, but is it a permanent proposition, or is it willing to change?
Thank you so much. And I think those are very good questions. I'll take it back a little bit. So basically what we're trying to do here is, the green space is very difficult to invest in, mostly because it's perceived to be very expensive, but also it's perceived that returns are low. And I think it requires that bit of blended financing. So if we're considering concessional funds, that will allow us to de-risk that space. So of course we reach out to DFIs, provide us capital, will promise that return at the same time the impact that you envision. And then of course once you go into commercial capital, Shahira will have those annual reviews where she needs to get the returns. So we have to promise you'll get a return from this. At the same time, as a pension fund, you also need some bit of impact. So we'll provide that. So it will be that kind of arrangement where we'll engage, yes, DFIs will engage banks if they can provide debt. But again, when we say we are adding equity, it doesn't mean we're going to give up on grants. So the grants builds the pipeline. The equity bit builds the growing companies that we can later exit out of as they keep on maturing, and you keep that going. So the whole idea is to catalyze the whole value chain, the whole growth phases of companies. So I hope I've answered that question. Thank you.
Thank you very much for sharing your vision, and I hope Shahira will be comfortable putting her money there, and then those of us who are in Uganda can follow her by investing the way she's investing. I've been to Rwanda. I was there in December, and I must say there is a lot of things happening. You can see order. And just on the streets, you can see order, and want to believe even inside companies in the corporates, there is order. I wanted to know if there are some restrictions, and I think maybe to go to you and Rona, are there restrictions on appointment of directors and executives in companies and organizations or the investment groups? Because we know in some jurisdictions there are controls on ownership, minimum ownership, and appointment of directors. Is that there in Rwanda? Because if I'm to invest in Rwanda as someone who is not a resident of Rwanda, there are some things I would want to look at. And then you've shared the vision, yes. As a person who would want to invest, I would want to know on the other side of how the money is coming and the returns, to learn a bit more detail. Are you going to have sessions where you will be sharing a few more details, or just be on a one-to-one discussion? Thank you.
Good question. Rona wants to take the first one, so I'll let her take it.
So in terms of board membership and ownership, there is no restriction on ownership as a foreigner, but one of the substance requirements, if you structure as a foreigner, is that we require that 25% of your board members are residents in Rwanda. They don't have to be citizens, but residents. And that a few of your board meetings take place in Rwanda, and you hire 30% Rwandans of your total staff.
Thank you so much for that. So that's a very good question. Returns, right? I want that money. And we are still trying to structure the Fund 1 and Fund 2. But what I can say so far, we are envisioning between 14 and 16% return for the commercial investors. And that is something that once we stay in touch, we can share as it comes out. So absolutely, it's a conversation we can have today after here, and then we can pick it up from there. Thank you so much. And of course, the returns come from the business performance, at the same time exits. So we're also trying to, like Shaira mentioned, we're trying to give that time for those businesses to grow. But also, we are very optimistic about it, given how the markets are evolving.
Giving him a thumbs up. We went to school together.
Yes. So that's my hobby. I went to school in Uganda, so yeah, this is home, my second home. Sorry? Yeah. Yes, it's here in the backyard. Uganda Matters Namugongo. Yes. Yeah. Thank you so much, and let's connect after here. Appreciate it.
Right, thank you so much. Now that we've come to the end of our presentations, we're going to the very exciting part of this discussion where we bring all these three perspectives in one conversation. And I'm very excited to invite, as I call him, our pioneering charter holders, Patrick Mutimba, to welcome our panelists as we set the stage. I have Grace, our society manager. She has very interesting news she wants to share as Patrick gets ready to come on stage. Grace has some very interesting news that she can't wait to pass and doesn't want to miss this audience.
Hi, everyone. We hope you're all okay. I'm the face behind the emails you've been receiving. So at least it's good to see you in person. So I'm just here just to invite you officially to tomorrow's conference. We're really excited. It's our 4th year, so come and help us celebrate that AIC has gotten to its 4th year. Not all things get to the 4th year, right? All right. So if, in case you have not downloaded the Glue app, this year we made sure we give you a platform that you can be able to network with each other. Those who've been calling and asking us who's in the room, Glue app will show you who has already registered and who's coming, when they'll be arriving, and all those things. So you can even book your side meetings together and, discuss one-on-one. That is the purpose of that. Glue app, if you do not know how to do that, see myself or Ruth will be able to walk you through. We also have our gala dinner, and when I'm also an old student from Uganda, we used to dress up for our dinners. So I don't know if that's still the culture in the corporate world, but I will wait to see when you grow up, what people do, right? So we hope you'll also attend our gala dinner, which will be in the evening, so you can, chill, come with a refreshing costume to dress down in the evening. We'll provide the changing rooms for you in case those things are there. So come looking pretty for dinner, and let's continue the great conversations that will not be able to be done during the day. And then, so we hope you're excited to be here. And in case you would also want us to work with you and have different meetings like this, talk to myself or Ruth. We'll be able to organize different stakeholder breakfasts with you all. Otherwise, we are great to have you. And karibuni sana.
Asante, Grace. So again, I want to welcome Patrick, to invite our distinguished panel to take their seats as we get settled, and then they'll take us through a combination of all these presentations, and I can promise you it's going to be a very engaging panel.
So for this session, I'm very, very excited that we're going to have three very interesting people who are going to give us their perspectives on the issues that we've been talking about. I want to start with the lady you've known. She's Shahira Zakirin, CFA. She's, as you know, the head of asset management department at RSSB, and she will provide her perspective on some of the issues. Shahirin, please. Ladies first. You've given her a round of applause, have you? Hey, beautiful, beautiful. I would like her to be escorted by Mr. Alex Ponton. He's Manager Advisory at I&P, and he will also share insights from the fund management industry. I suspect you'll also take a moment to tell us a little bit more about I&P. I learned, for those of you who are from here, I learned nti ayogera bulungi Oluganda. Musajja yeddira mamba. He's from Masaka. Mubiru. You're welcome. Bienvenue. He's actually a global citizen from all dimensions. And we'll be joined by my neighbor, Mr. Stephen Tumwesije. He's a managing partner at Taslaf Advocates. He will also offer expertise on legal and regulatory frameworks that would help us support domiciliation. Mr. Tumwesije, round of applause. Okay, so you can see they've all sat, and they've left one chair for me, and I have to move all the way to the end. So let me do what I need to do. Or do you want to? Okay. Do you have another mic, or we only have two? I'm just going to raise one question to each of you. And I think I'll take a seat. It's been for me a pleasure to really be with you. And when I raise these questions, I would like you to take the liberty, one, to give us your view, but you may want to spend some time and tell us a little bit more about your work as well, just for some of us who may not be very well familiar with what you do. We will then have one or two questions which will be generic. I realize that some of the questions that we asked, for instance, targeted at you, Shahira, the other gentlemen may want to pitch in even after you've responded. So they may do that. I'll just let that free normally. But I would like to target the first question to you. And I would just like to request you to, from your own perspective, can you help us explore precedents on jurisdiction selection? You can highlight some considerations for institutional investors that you think we should be very, very cognizant about on this continent.
So thank you for the question. So basically, what are the considerations? What's going on in my mind, basically, when we select a jurisdiction? Before I answer that, maybe just to give a context on what RSSB does, specifically what's our work so far in the private funds space, right? So as an institution, we are still relatively quite new, actually, in investing in the private fund space. So in Rona's presentation earlier, she mentioned Virunga Africa Fund with Admires Capital Partners. So that was in 2021. So one of the first funds domiciled by KIFC, but it's also RSSB's first investment in a private equity fund. Okay, so after that point onwards, 2021 until today, 5 years later, we have closed investments in, I would say, six private fund structures. So we have PE structures, we have VC structures. We also invest in ISATAF TDB. So that's an existing trade financing fund. We also structured our own Rwanda SME Growth Fund with Enco Capital just now. So there's a mix of us investing in an existing fund versus us being part of the setup of a new fund. So in terms of consideration, this is one of the times that I wish my chief legal officer would be here. But in the process of closing these investments, we've had a lot of engagement. So if I may do him justice. So for a Rwandan institutional investor who has a very strong mandate, not just for the pension fund itself, but to develop the ecosystem in Rwanda, in terms of the jurisdiction selection, there's obviously going to be a home bias. We will select the Rwanda jurisdiction. That is especially true for funds that we set up, or the new fund managers or fund manager who wants to set up a new fund and they want our capital to come in, that's when we say we can do that, but can you set up the fund in Rwanda? Can you domicile the fund in Rwanda? Maybe for an existing fund, for example, Africa 50, we don't have the luxury because they already have set up their fund to be domiciled in Mauritius, hence the Mauritian law. But then the conversation will steer towards then can we have a feeder fund structure? So those are the considerations. Second thing maybe I would like to highlight is that so for example, again going back to the Africa 50 example, of course by default we will choose the Rwandan law to be put in our LPA, but that's not always always the luxury that we may always have all the time. So that's when we will that's the negotiation between the LPs and the GPs. So sometimes they will say we will have to go to more. It's already domiciled in Mauritius. It's already set out in the LPA that we follow the Mauritian law, and then the arbitration place is in London, is in England. But then we will always try to to make sure every single clauses it's in it covers us from a legal perspective, and we do take this thing seriously. If the fund manager if they can't even meet us halfway, we might even say sorry, this is a deal breaker, we won't even invest in the fund. So I would say in terms of obviously as RSSB there is this home bias, right? That we want to be domiciled in Rwanda, we want Rwandan law, but I tried to take off that cap as well and think, if I am not RSSB, why would I choose a Rwandan jurisdiction? Why not Mauritius? I mean, Mauritius, it's already been around for more than 30 years, right? We have deep precedents. A lot of the fund managers, a lot of the lawyers, etc., they already know Mauritius. So why reinvent the wheel? Why do we need to go to Rwanda? So ChatGPT helped me with some of the answers. I'll be honest. But so while Rwanda, KIFC, we're still in the foundation building phase, right? We're still in the first decade. But what differentiates KIFC versus Mauritius is I would say the laws and the frameworks that comes under the Rwandan domiciliation is that it's okay. The lawyers here can I stand corrected, but so it's not purely common law. So there's a bit of elements of common law and civil law. Don't quote me on that. So so the design of the law is more modern. So the reliance on the precedents is less for Rwanda, and that means that it's a better structure, especially for more modern investments. So I'd say that is something that's definitely worth looking into, regardless you're an LP, regardless you're a GP as well. And also is that some of the advantages that Mauritius had a few decades ago, it's like, so Mauritius, it's an island far away from continental Africa. Why does that work for an investor in London? It's because 3 decades ago, we may not have direct flights to come to Kigali, for example. If you want to come to Kigali, where do you stop? Mombasa, and then a few days journey inland. So it's not really helpful to do business in the 80s or the 90s with that sort of limitations, right? So it's just a lot more easier to take a boat to go to Mauritius. That's where you need to do your board meetings and etc. But now we are in the 21st century, so maybe what is more important rather than that is just the digital connectivity, the digital infrastructure, the commitment of the government to just be more intentional about setting up Rwanda as a domiciliation instead of just an organic growth. So I would commend my colleagues in KIFC that even though they're it's only been 6 years, by comparison, Mauritius is a married adult with 2 kids, and Rwanda is still in kindergarten, but we've already had like almost half, right, of the DTT agreements compared to Mauritius. So that just reflects in the intentional efforts of the jurisdictions, and of course Rwanda, in terms of the low, zero corruption, and it's just the political stability that goes along with it. And also, Rwanda, we are actually in continental Africa. We are actually closer to the assets itself. It's not just about having a mailbox jurisdiction to just set up a fund, but you don't actually generate economic activities there, right? So that's you have to have that significant presence in Rwanda to actually have that sort of to reap the benefits. And I think again, lawyers in the room, you can add on more to this. It just from a KYC perspective as well. It's just so there's been talks about in the OECD community, in the EU community, just basically the sentiment globally about how certain island jurisdictions like Mauritius and Cayman Islands, it's just can be deemed as a bit more riskier when it comes to this tax haven status. So Rwanda is not that. We are actually in the center of Africa. So that's my perspective, I would say. Yeah, thank you.
Very, very interesting. And as you're saying, I'm going to let you just go on, but something that caught my mind as you're is something that Omugurusi Alfred mentioned. I've known this gentleman for a long time. But much as he was in Rwanda, you say December? I was there. Yes, I was there in November. And of course, I was moving quite a lot. But what you said is very true. The roads are neat. People don't run red lights. Now, if they run red lights here, it could tell you what's happening in the companies themselves. So what Rwanda is demonstrating is that discipline would not be in a silo, but it will be experienced in different areas. So, Stephen, I don't know whether you wanted to come in at this point.
Just maybe to add on to what she has said. As a legal profession, obviously, we always ask this question. Why should I invest in Uganda and not Rwanda? Or why should I domicile my fund in Mauritius and not Luxembourg or Singapore or the Cayman Island? Okay. Kigali, which has been really fantastically expressed by Ron as well. I think, I didn't use ChatGPT, but the MasterCard Foundation, I don't know whether there's anyone from the MasterCard Foundation, but the MasterCard Foundation last year did a diagnostic study on the domiciliation of funds in Africa. And they did a ranking of, the different countries. And when you read the report, you'll see where Kigali and Mauritius rank. But they identified maybe 3 or 4 considerations for why one would domicile a fund in a country and not the other. And I think the first point was, number 1, ease of doing business and competitiveness, which Rona highlighted. For many investors, one of the considerations is, can I actually set up this business and run it efficiently without the normal long procedures and red tape? Okay? So I think Rona highlighted that in Rwanda now you can set up a company online. You can file your returns online. There's ease of doing business. Okay? Without sounding unpatriotic, I'm sure there are countries somewhere in Africa where we still have physical documents being submitted, wet ink signatures required, and such the like. So the ease of doing business, which is also in line with the competitiveness framework, and how actually it is easier for you to run a business. The second point that the MasterCard Foundation identified is the rule of law and the administration of justice. So I have set up the business, and now there's a conflict. Maybe I want to exit an investment. How long does it take me to actually get a decision from the courts? Or what are the procedures for mediation, arbitration, and dispute resolution? Okay. Casablanca as a jurisdiction actually set up a separate arbitration mechanism for investor disputes. So that makes it attractive for investment. I don't know, my learned friend Alan, how long does it take for you to get a judgment from the Commercial Court of Uganda? Give and take.
3-4 years.
3-4 years. Perhaps you're a very efficient law firm. But yeah, how easy is it for you to actually get a decision from the court system? And if the court system is not working, how easy is it for you to then utilize the other mechanisms? I was reading a report from the commercial court, and it says that 6 trillion Uganda shillings is tied up in our commercial court disputes for the last almost 10 years. So just imagine the amount of capital. Even if you're going to go into international arbitration, how do you then enforce those judgments in Uganda with any other country? The third issue they identified as MasterCard, which I agree with, is that there should be a taxation regime that allows for both double taxation agreements, but also the capacity for you to then repatriate your profit earned either on dividends or on interest. So Rwanda has already identified, the Kigali International Financial Center already has DTAs with so many countries. I think Mauritius, of course, has more. But how are you interconnected with the rest of the global financial world? And how are you then able to utilize the double taxation agreements for you to then benefit the investor who is taking back their profit? The other, which is extremely important, I think, was around anti-money laundering. Okay, so they mentioned anti-money laundering structures and how your financial action task forces are able to then minimize money laundering. Because even if you're not involved in money laundering yourself as a fund or as an investor, the triple effect is that if you're listed by the FATF, I think it's the FATF, on the grey list, which I think Mauritius has been on the grey list. Uganda has been on the grey list. I think Kenya was on the grey list. I think the Kigali people want me to say that they have not been on the grey list. Yeah, but that shows you the efficiency, okay, and the attention detailed in regard to, robust financial systems that then promote your destination as an investment destination. I think the final one, which I will mention and then I will hand over to Alex, is the broader economic policy and how it plays into the, fund domiciliation. So what is the interaction between the tax authorities, the central bank, the ministries, and all the other players in the market, and how does that then facilitate my business or a fund to come into your jurisdiction? So in that report, again, they identify that Luxembourg and other jurisdictions did not set out as fund domiciliation structures, okay? They grew their economies, and then the funds moved there. So the funds followed the economy. So rather than have the focus on, developing the fund domiciliation structure, you'd rather develop the broader economic structure and then attract these funds into your countries. We've been doing this with the AFCA in Uganda. The East African Venture Capital Association 2 years ago did advocacy around reform of our own capital markets, fund domiciliation structures, and we highlighted 2 areas. Number one, in Uganda today, under the 2024 Income Tax Amendment Act, a venture fund and a PE and venture fund, actually, their income is exempt from income tax. okay? Their income tax, their stamp duty on increase of share capital. And then we had another structure where all funds had to go through a company structure. But then we amended our partnership regulations now to allow for limited liability partnerships. Yeah, so again, I think that that's part of our reform structure, which I think even Nairobi is doing. So if you're going to be an investor looking for where to invest in Africa, you want to look at all those parameters and then decide where do I actually fit most, or where do these 4 or 5 things, where are they most convenient, where are they most useful, and then you can domicile your fund there. Yeah, I thought I would highlight Uganda for patriotic reasons.
Thank you, Stephen. You're actually saving us a little bit, but the competition is still there. There's one thing I need to ask you. Maybe I'll come back to that later because I see that Alex has got the mic. Alex, even as you give us your perspectives, and personally, I would like to benefit more from knowledge about INP.
Yeah, sure.
But alongside that, I would request you to discuss the operational considerations guiding a fund manager when making a choice about jurisdiction. Thank you so much.
Great, thank you so much. So my name is Alexandre Ponton. I'm the Advisory and Learning Manager at INP. So INP, we've been an active impact investor on the continent for around 20 years, investing directly in SMEs and startups across 15, I think, different countries. And we've also invested in around and supported around 27 funds all across the continent. Out in terms of jurisdictions, we invested in 9 different jurisdictions, so 2 the usual one, Mauritius and Luxembourg, but also 7 jurisdictions on the continent. So I'll try to share a little bit of that perspective in terms of the considerations, trying as well not to repeat myself too much from the previous speakers. So when it comes to thinking about a jurisdiction as a fund manager, especially if you're an emerging fund manager doing an SME fund or a VC fund, for example, it's important to note that most of the time you're a jurisdiction taker. So a lot of the time when it comes to your domiciliation, it's going to be driven by your LP, your anchor LP that you're trying to secure. So what it says is that, yes, we need to support the fund managers in the ecosystem. Let's say if we want more funds that are domiciled in Uganda or in Rwanda, for example, they can be great advocate for that domiciliation and that jurisdiction. But at the same time as well, a lot of the support needs to come from the different LPs, and there needs to be some education on that front as well. So number one is that sort of LP acceptability of the jurisdiction. That's a very clear consideration that comes into mind. So the work, for example, that RSSB is doing in Rwanda, anchoring some of those funds, backing and sort of doing that, putting that stamp of approval, if you will, on this jurisdiction, that can be extremely powerful, beyond like the tax consideration and so on. That's more the second point. The second point really is the operational readiness of the jurisdiction. So the work that the KIFC team is doing on DTA, on building the talent. Of course, I'm preaching to the converted here, but when I saw the post on LinkedIn that there was 25 CFA, 24, 25? 25 CFA level 1 that passed the CFA level 1 exam in Rwanda. Of course, that goes into building the ecosystem and getting it ready. When I first moved to Uganda in 2015, it was really hard just to find an analyst to work on your fund and to run due diligence. And what I actually did at the time is I went on the CFA website and I cold emailed every single CFA chart holder in Uganda saying, hey, do you want to be an analyst in an impact fund? So building that ecosystem is super important. I did get a person, yes. So that was great. So number 2 is the ecosystem readiness is very key. Number 3 is the alignment with the strategy. I think if you're looking, let's say, at your first fund, it's a $10 million fund or $20 million fund. It's a proof of concept fund, and you're targeting, let's say, East Africa. Then it might be a better idea to actually think of a structure that is locally domiciled, that fits within your region, that makes Rwanda very interesting in that front. As opposed to, let's say, going to Mauritius, Luxembourg, and so on. The fourth one is obviously the cost. Again, if you're raising your first fund, going in a structure, let's say in Luxembourg or Mauritius, that can be much more expensive to run, much more challenging. So there's that component. And the fifth one, and I think I'll conclude with that, And it's the one that sort of reinforces the four considerations before, is that, there needs to be consistency and trust behind the jurisdiction. What I mean is, like, one of the formula that I like to use all the time, what I like to use all the time is trust equal consistency over time. So if you're able to really test this jurisdiction, if you're able to show case studies of funds that were actually able to raise their fund managers that were able to raise their funds in Rwanda, then use it as a base and prove that the infrastructure is there, prove that the legal frameworks are clear, prove that the talent is there. If you do that repetitively over time, then you're going to be able to build that magnet effect. So that's really like the consideration. It will take time. You need to be patient. I think the analogy of, Rwanda is still sort of at the early stage as compared to Mauritius that is much more advanced, yes. But over time, if we continue that consistency, that's when we're going to start seeing a lot of results and more fund managers actually considering the jurisdiction for domiciliation.
Thank you, Sofa. I just want a follow-up question. Either you or any of you good panelists. One is, do you have any comments around, when you're a financial center like Kigali, incidentally, it's Kigali. It's not Kigali. You can correct me, it's Kigali. Okay, KIFC. If you are continent-based, I think one of the issues that is looked at is resilience on the internet connectivity. To what extent does any of you think it's a primary issue, even for Rwanda right now? Or do you or some of the colleagues, do we feel that is ground that's so far well covered, there's nothing to worry about? The other thing, again, I want to ask is around currency convertibility. I think Rona talked about repatriation and all that. Maybe just to confirm that that's not an issue. I've been in countries where it's officially multi-currency, but in reality, you don't have the freedom. So we just want to get assured. And with that, I don't know if, Ruth, we can have any questions from the audience, or I have two after that I can again raise generally. But I would like them to first address these two, and then we see if we have any questions. Data pathways and currency.
I think the data pathway one, when you look at fund managers, the way we like to call them, they're capital entrepreneurs. Effectively, they're trying to raise a fund, they're entrepreneurs in their own right. So the point on data connectivity, let's say in the context of raising, let's say, an SME or VC fund, or the ease of like traveling across the region, for example, those are things that make it just easy for you to actually operate, actually engage with your investors, whether they're local and foreign. So it does play a key role in that sense. Of course, there might be more to the question around like public market and connectivity in that front, but like on the fund manager point of view, the more you can ease some of those points, the easier it is for you to operate, the easier it is after that for you to engage with other investors. So that's number one. I think the other point on currency repatriation, it is still a question mark. I think when we talk to LPs about, or partners, let's say on potential funds about Rwanda, it's always a question that comes up. So it is also a point where probably more education, more sensitization needs to come to actually educate those LPs around the jurisdiction. LPs are not always necessarily the most innovative. Let's say if you look at, more traditional ones. But if you can educate them on that front, and then if, of course, there's some support, let's say from local LPs like the RSSBs, that can also enhold some of those international LPs around those questions, then that can help sort of close that gap and address some of those recurrent questions on currency and so on.
Maybe just a quick point to add in terms of the internet connectivity in Kigali. I would say we have Kigali Innovation City. We have data centers that's been developed in Kigali, and one of the I would say priority sectors for RSSB and also the SME Growth Fund as well will be on infrastructure investing, digital infrastructure. So I would say that we, as RSSB personally, for now, we don't have that kind of issues yet. But I can comment that the trajectory of the country in terms of the digital infrastructure, investing in that, we're bullish on it. Yes, we're definitely bullish. Yeah, thanks.
Thank you so much. Do we have any I want to know how many, because I want to take them at a go. So we have one, we have two. So let's take those two, and then we'll close.
Thank you so much to our panelists and the moderator. Mine is rather a statement, maybe just to add to the voices, especially when we were dealing with the question of domicile, and a point that Stephen hinted on. Well, he tickled me into into this discussion, so I will also just share my few insights. I think we need to know what a safe place is for any investment, for a fund to get into, and there are a number of considerations. Yeah, and as Stephen has shared, you want to first also consider the legal, what makes a safe legal space, and of course, as he hinted on the three key areas, there is one aspect that we didn't allude to, which is also political will. Yeah, at the end of the day, you may have laws that are very effective, that look effective, that are not ambiguous, that are not abstract, but without that political will, the policy of government to see that cross the finish line through other support systems, then you will not be able to have a safe space per se, right? And this goes into other infrastructure, security, and the like. But then I want to draw us back into the legal realm, and a few cases that are close to home and close to our space and to our discussion. I know we are all, some of us could know about the Vantage, yes, mezzanine fund that has gone on since 2014, went to the Court of Appeal. I want to think they're in the Supreme Court, and they will be summoned anytime soon. So you find that you have a South African firm that got into a transaction or an agreement with a Ugandan firm, but because of a few technicalities in respect to regulatory aspects, should a foreign entity have to first register in Uganda in order for it to conduct business in Uganda, then you get into a question where you have to litigate the number of injunctions, the number of stays, whereas I did mention that you could possibly litigate a matter in the commercial court for 4 to 5 years. You see that a dispute that crystallizes in 2016 being litigated in the commercial court for, if you're lucky enough, 3 to 4 years, and that's because it's a high-stakes case. It has so many big stakeholders looking at it. And then you go to the Court of Appeal, which is going to take about 3 years. You're going to go to the Supreme Court. What kind of message are we sending to the investors out there? So you find that longevity and also questions on regulation. I'm happy that KIFC did hint on a few aspects regarding board and directorship. You would notice that maybe certain questions give, from a compliance and regulatory perspective in Rwanda, you may not have to address such questions when you're in Uganda. So it's a good thing. Then, and that just goes back to rule of law and administration of justice, the legal framework. I know my friend Stephen would also want to consider whether when you're dealing with funding, you also have to at some point think about cross-border lending. And we've seen the cases of DTB Kenya, DTB Uganda with Ham Properties, Ham Enterprises. Do I need to be licensed by the domicile central bank in order for me to give money to a fund manager or to an investor? So it's interesting. Those are questions we need to address in order to understand what makes a safe legal space for an investor. But then back to the question, when we were dealing with the difference between, the pros and cons, where maybe Mauritius would have a more competitive advantage than Kigali. I have been lucky enough to sit in spaces where we've discussed the legal framework of both stations from an arbitration perspective, yeah? And of course, given the duration of our cases these days, you will find that investors are now more keen on let's have arbitration clauses for a number of reasons, yeah? But also the fact that you can easily deal with a matter within a very short space of time. And it gives you some level of confidentiality depending on the rules that you apply. So you'll find that Mauritius is a bit more progressive because of the partners that it has. The Mauritius International Arbitration Center partners with the London Court of Arbitration, with the Permanent Court of Arbitration and the London Center of International Arbitration, which maybe the Kigali International Arbitration Center may not have. And one gives a more global outlook. Maybe then that means also the technical people that would deal with disputes. It has a wider pool of arbitrators, a wider pool of technical knowledge on how to address certain fund disputes, as opposed to KIAC, which is largely regional and which is has a number of local competition from South Africa, Kenya. So I think those are aspects we would want to look at. Thank you. That's all.
Thank you very much. Thank you for sharing your wisdom. 3 quick ones. The first one, we've been told that the investors from outside Africa, when they are looking at us, one of the things they look at is where are we as Africans investing? Where is our money going? You mentioned that you have a fund of about $2.5 billion. I don't know if you are free to share with us from a high level insights of your asset allocation, because we know, like in Uganda, you find 90+% of the monies, not just for the National Social Security Fund, but also for the other funds. You find the biggest percentage is actually in government securities, bonds, and treasury bills. So I wanted to know from your perspective, that 2.5 billion, where is it? And that gives us a bigger picture of what is happening. My second comment is that as we set up KIFC and also the initiatives in Uganda, I think as Africa we need to realize that, and that is how I look at it, we are not competing with you. We are not competing with Rwanda. We are not competing with South Africa. We are all Africa and pulling opportunities here, because we are just a small percentage of actually the global markets and the global cash flow and the global investable funds. So as we discuss, and that's why I was asking, how are you collaborating with the entities in Uganda? It is better when we see what you are doing and we identify what we can replicate and where the gaps are, so that we synergize. In that way, I think we'll be growing in a better way. Because as Africa, I'm told at the moment we have investment gap of more than $3 billion for just infrastructure. And if that is the figure that is recorded, and we are dealing with alternative investments, I'm sure the figure might be even 10 times that. So as we collaborate, we'll be doing better. So one of the challenges is actually the country risk premium for Africa and for the countries. We pay much more interest on the investments than our similar companies outside the African continent. And I was thinking that as we do whatever we are doing, we need to keep thinking about that. I think last time I had someone costing that to more than $10 billion that is paid on the African continent in form of risk premium when you are investing here. So we need to be thinking, how do we deal with such challenges? Last but not least, again, to emphasize that we need to collaborate more. When you collaborate more, we will actually do much better than we are doing. Thank you very much.
Thank you all very much. I would like to request you to, before I ask you to give a round of applause to yourselves and especially our panelists. I just want to bring your attention to tomorrow's event. As Alfred was speaking, I was just thinking about some of the sessions that are going to come tomorrow. Even as well as when you were talking, I thought, like she said, I just need to put emphasis. Let's make sure we are here tomorrow and get more insights. Maybe we'll even share more from what we've been able to share. But please join me in giving a round of applause to our panelists. Thank you all very much for your time, your insights. And I would now like to hand over to the Chief Executive. Thank you.
Thank you so much, Patrick. Let's give them another round of applause as they step down. Thank you very much to all our panelists. Thank you, Alex, Patrick, and Shahira. Thank you so much. All right. Thank you so much. As we wind the morning down, thank you so much for being a very engaging audience. I think the conversations are really enriching. As we wrap up, I would now want to invite KIFC, our host of the day, to officially close this session and provide us the closing remarks. I would like to welcome Anita. Please take the stage. Thank you very much.
Thank you. Thank you. Thank you, Ruth, and thank you, everyone, for being here. We want to believe that when we come to Kampala, when we see what's going on in the city compared to Kigali, we want to believe everybody's busy. Yes, so we came in yesterday and we had to learn how to walk on the streets because the boda won't hoot. There's no path for you to know where to walk, but we want to believe Ugandans are busy people. Yes, thank you very much for your time. So saying Ugandans are busy, your time is valued. Thank you for being here. We appreciate you. This is actually the first time KIFC is hosting such an event in Uganda. Yes, so we have come, and when we come, we don't stop coming. So we'll keep coming, and Alfred talked about synergies. This is where it starts, and we'd like to appreciate your time and you listening to us. I think we have many ambassadors on the panel. Apart from Shahira is part of us. Stephen and Alex, the way they speak about Kigali, I believe today we'll have fun wanting to structure with us. So I think earlier you asked, it was Alfred, I think, who asked about the order you see in Kigali, if it's also in the institutions. Believe me, it's order everywhere. So we come. It's KIFC, but we are not just KIFC as an institution. We are an ecosystem. That's why we come as Team Rwanda with RSSB, with Rwanda Green Fund. Actually, there's also BK Capital. I don't know if he made it. Yes. BK Capital is here. And it's about, from our presentations, you can see it's not about Rwandans only. It's about Africa and how we can move forward as one team. So thank you again for your time. I don't know if George is here. I think he left. When we started 5 years ago, the CFAs were not even 5. Today we are competing with Kenya. So when we mean business, we're in business. I don't know about Uganda. I don't know about Uganda, but Parfait is a good example. Please, when you have time, reach out to Parfait. He's a good testimony of how quick we have moved with CFA. So again, I thank you for your time and looking forward to tomorrow and more of such events in Kampala. Thank you.
Thank you very much, Anita, and a big thank you to all our speakers, panelists, and to you, our audience. So I'd want to open it up for networking. Feel free to interact. We have the room until 2 p.m. We still have some food to eat as well, so let's take our time in the room. Enjoy.